This channel covers precious metals, macro finance, and geopolitical market analysis. No emotion, no guessing, data only. Before we go any further, I want to flag something directly to this audience. There are fake accounts and copycat handles using names and content similar to this channel to sell products, signals, and courses. We do not sell any of that. The only verified handle for this channel is the one you are watching right now. Confirm it before you trust it. Now, let's get into today's content. This video runs approximately 10 to 12 minutes. Do not skip sections. Every piece of analysis in this video builds directly on what came before it. If you jump to the end, you will get a conclusion without the foundation, and a conclusion without a foundation is just an opinion. Watch the full video. That is the only way to understand what is actually happening in this market right now. In the last video, the call was simple and specific. Gold had closed its first hourly body above the $5,000 structural level for the first time in history. The stated thesis was that a confirmed hold above $5,000 opened a measured move toward $5,150 to $5,170, and that the more volatile the macro backdrop became, the faster that move would compress in time. That is exactly what happened. Spot gold tagged $5,170 on January 27th, while futures hit $5,163 at the same session. Both numbers are on record. New viewers, go back and check the previous video for the timestamp. The level was stated before the move, not after. Now let's get into what is happening today. Here are the numbers. Spot gold hit $5,170 per ounce. COMEX April futures settled at $5,181 per ounce. That is gold up more than 15% in the first 26 days of 2026 alone, following a 55% gain across the full year of 2025. The total market capitalization of above-ground gold investment holdings added an estimated $1.3 trillion in notional value since the January 1st open. Meanwhile, crude oil surged 8.2% in a single session on Strait of Hormuz disruption fears, and the US dollar index softened 0.7% in the same window. Three markets moving in the same direction at the same time. Gold up, oil up, dollar down. That combination does not happen by accident. It happens when something fundamental has broken in the underlying risk architecture of global markets. The question is, what broke, and why is gold the instrument telling us first? On the surface, this makes no sense. Here's why. When oil surges because of a war event, the standard playbook says inflation expectations rise. Rising inflation expectations historically force the Federal Reserve to keep rates elevated or signal further tightening. Higher rates mean a stronger dollar. A stronger dollar is supposed to suppress gold. That is textbook. That is what every introductory economics course teaches. But what actually happened was the opposite. Oil jumped, inflation fear spiked, and gold moved higher simultaneously. The dollar weakened. The transmission mechanism that was supposed to keep gold contained simply did not fire. That disconnect is not noise. When a market stops responding to its own historical correlations, it means the underlying structure has changed. That is worth paying attention to. Here is the layer that mainstream financial media will not spend 30 seconds on. While Western spot prices were printing $5,170, the Shanghai Gold Exchange was recording net inflows of 112 billion renminbi in the preceding quarter. Physical demand on the SG did not slow down as prices rose. It accelerated. The physical premium on gold contracts in Shanghai widened to over $8 per ounce above COMEX during peak sessions. $8. That is not a rounding error. That is a structural bid. The People's Bank of China confirmed at the end of February 2026 that it extended its gold buying program for a 16th consecutive month, bringing total holdings to 74.22 million fine troy ounces. Don't trust me on this. Verify it yourself. The PBOC data is publicly filed and timestamped. The East is not watching gold. The East is accumulating gold at prices Western institutions are still debating. That divergence is not accidental. When the world's largest manufacturing economy buys physical gold for 16 consecutive months, it is a policy signal, not a portfolio trade. Now let's connect the macro structure. Two events converged this week with direct implications for gold pricing. First, the escalation of US and Israeli military strikes against Iran. The Strait of Hormuz, through which approximately 20% of global seaborne crude oil transits daily, came under operational threat. Oil markets responded with a 13% intraday spike on the session when Hormuz closure risk peaked. That oil spike is not just an energy story. It is an inflation story. When energy input costs rise 13% in a single session, every downstream price in a supply chain moves. That feeds directly into CPI expectations, which feeds into real yield compression, which historically feeds into gold demand. Second, Federal Reserve Chair Jerome Powell publicly acknowledged that inflation data for January 2026 was, in his words, uncomfortably elevated. That language matters. It means the rate cut narrative that equity markets have been pricing is now in question. When rate cuts get repriced away, risk assets fall. And when risk assets fall under a geopolitical shock, capital does not go to cash. It goes to gold. Event A produced Event B. Event B produced Event C. Gold was Event C. That is the chain. Now let's go one layer deeper. Understanding price action in gold requires understanding who moves the paper market and how. This is not a theory. It is documented. In September 2020, J.P. Morgan Chase admitted wrongdoing and agreed to pay $920.2 million to resolve federal investigations into manipulation of the precious metals and U.S. Treasury markets. The breakdown: $436.4 million in criminal fines, $311.7 million in restitution, and $172.0 million in disgorgement. This covered 8 years of verified spoofing activity on COMEX gold and silver futures. Deutsche Bank separately paid $5.6 million under a deferred prosecution agreement for related commodities conduct. The mechanics are straightforward. A large institution places a significant sell order, sometimes thousands of contracts, with no intention of executing it. The visible order pressure pushes algorithmic and retail participants to adjust their bids. The spoofer cancels the fake order and executes their real position at the manipulated price. The structure is always the same. Manufacture the price, then trade against the manufactured level. As of this week, COMEX managed money short positions stand at 23,151 contracts. When you see concentrated positioning like that without a matching fundamental catalyst, you now know what to look for. The documented history tells you the pattern. This is educational analysis only and not financial advice. On the hourly gold chart, the level to monitor on the downside is $5,130. That is where the 150-period exponential moving average on the hourly converges with a prior structural consolidation zone. A full hourly body close below $5,130, not a wick, a confirmed body close, opens a retest of $5,046, which aligns with the 20-day moving average on the daily chart. To the upside, $5,250 is the first resistance level that matters. A confirmed hourly body close above $5,250 with expanding open interest would suggest institutional participation, not just retail momentum. Current COMEX managed money short positioning at 23,151 contracts is elevated relative to the 12-month average of approximately 26,000. That compression in short positioning, if it reverses, could accelerate a move through $5,250 faster than price action alone would suggest. Watch the open interest alongside price. One without the other is incomplete data. The honest read requires acknowledging the risks the bull thesis has not yet resolved. First, gold pulled back nearly 4% from its January high to $5,075 within 72 hours of the $5,170 print. That is a sharp reversal, and it has not been explained away. Second, central bank bonding, one of the structural pillars of this rally, showed a meaningful slowdown in January 2026, falling to just 5.0 net tons, an 80% drop from the prior 12-month average. That is not a trend confirmation. That is a warning. Third, if the Federal Reserve signals tightening rather than cutting in its next meeting cycle, real yields will rise, and that creates genuine headwind for a zero-yield asset. These are not fringe scenarios. The data does not yet confirm that the January high will hold as a floor. That is an honest assessment, and it matters for how you size your exposure. But here is what did not change. The PBOC bought gold for 16 consecutive months through February 2026, verified by their own public filings. Central banks globally accumulated an estimated 850 tons in 2025 alone, even at record prices, a behavior economist Alastair MacLeod has described as a structural de-dollarization cycle, not a tactical trade. The Shanghai Gold Exchange recorded net inflows of 112 billion renminbi even as prices rose, confirming that Eastern physical demand is not price-sensitive at these levels. COMEX short positioning at 23,151 contracts remains structurally significant, and Goldman Sachs, JP Morgan, and Deutsche Bank have each revised their end of 2026 price targets to $5,400, $6,300, and $6,000 respectively. None of those structural inputs reversed this week. Price pulled back. The foundation did not. Watch physical premiums. Watch SG inventory flows. Watch PBOC monthly filings. Price is the last thing to know. The structural data moves first. If you want real-time updates as events develop, follow the official channel handle, the one you are watching right now. That is the only place this analysis gets published. Thank you for spending 10 minutes here. It means more than you know. The signal in this market is getting louder. Stay focused on data, not headlines. Invest with logic, not hype.